Well, investors are increasingly moving into new housing estates. Could Labor's housing changes be creating an unintended disadvantage for first home buyers? Anthony Lundell is joining us from Equilibria Finance. Good to see you.
Nice to be here.
We were just talking earlier there in regards to the RBA even referencing that perhaps they were surprised of how deep this correction, if you'd like to call it, in the property market is transpiring at the moment. So obviously interest rates are an issue, as are these policy changes, courtesy of the budget. So what are you seeing at the moment?
Yeah, obviously we've had the inflationary data, which has been talked about a lot in the last few days. And the RBA governor even referenced the housing market softened more than they had forecast. We're seeing very much a split market. On the less affordable markets, we're really seeing drops in values. Over 2 million, over 3 million sort of property prices, we're really seeing less stock, and also people who are having to sell are taking a bit of a hit. We've seen properties undervalued by 5 to 10% from what they might have got 6-12 months ago in that higher end market. The real shift we're seeing is investors are moving into new estates. Investors are moving into what was traditionally areas of where first home buyers go. For an investor buying an established property, they're probably down from a cash flow perspective, $770 potentially each week. Serviceability's down a couple of $100,000 because all of the banks are now making changes around negative gearing. So we're now seeing investors shift into what traditionally was a first home buyer's pond, which is the new estates.
So is that actually, though, are that investors looking to build, or is it actually established properties? Because I mean, that's the distinction, isn't it, in terms of the tax breaks available?
It's investors looking to buy a new build, either a land and construct or a recently built property that will still get the tax benefits. Traditionally, first home buyers have made up about 40% of that market of new builds. Investors have been about 20%. All the investor conversations and inquiry we're having at the moment is around new builds, and that's also being reflected in some of the conversations that the banks are seeing and some of the data that's going to flow through. So that $1 to $1.5 million market, traditionally first home buyers in the new builds, we are seeing investors already shift into that area.
What are you seeing more broadly with investors? Is there less demand now, or is that actually being picked up, as you say, now focusing on the new build market?
There's definitely a lot of caution. We haven't seen all of that investor flow into the new builds at all. But we are seeing investor conversations moving into that. Bank investor flows are down markedly overnight, virtually. Pre-approvals that we had for a lot of investors aren't worth the paper they're written on, essentially. Serviceability's affected, their post-tax cash position's affected. So a lot of it's about, if they're going to buy an established property, a lot more of it now is about the rental yield, because obviously the capital gains tax affected on the way out. And if it's a newer investor trying to get into the market where they're using that negative gearing tax benefit, because bear in mind a lot of people still positively gear and it may not be as affected, but a lot of the new investors where they're looking at getting that tax benefit or serviceability's tight, they're the ones shifting into the new builds.
So what effect is that? I mean, you mentioned at the top there, just as far as perhaps we're now seeing a collision between investors and new home buyers. How is this likely to pay out for new home buyers?
One of the, I guess, reasons the government gave for making these changes was to try and bring more first home buyers into the market. A risk is that it's shifting investors into what traditionally has been a first home buyer market. So the least affordable areas, those markets are the ones that are holding up more strongly than the more affordable areas are holding up more strongly than the least affordable areas. And that's traditionally where a first home buyer will look. So if we see more investors shift into those areas, the new builds, maybe the investment property, even if it's an established property that might not have as big a price tag, that gets strong rental growth, then it may actually be that demand in some of those first home buyer markets goes up. And again, the underlying problem really with our market is supply. So are we shifting investor demand into some of those first home buyer markets? Early signs are that yes, we are. And it'll be interesting to see what some of that data says in the months ahead.
What also, another issue to contend with is SMSFs can no longer borrow to buy. What effect is that likely to have?
The short-term effect is we're doing a lot of SMSF work right now.
So there's a rush.
There is a rush. Absolutely. Contracts must be signed by the 10th of August and it can settle any time after that. But there's about 2 weeks left. Look, it doesn't make sense to me. That SMSF environment is where you've got a lot of mum and dad investors utilising the superannuation framework to leverage into an investment property. Yes, the overall market share might seem small, but for a possibly self-employed, for a mum and dad with an SMSF setup, that may be the path through to part of their wealth accumulation strategy, buying a property. You can still purchase a property within your SMSF outright, but yeah, you'll no longer be able to borrow, and that'll have a big impact on that investor market again, which again will have an impact on rentals available, potentially an impact on vacancy rates driving up rents. So that is going to slow down. Commercial investments are unchanged. You can still borrow for them. You can still buy through your SMSF, but you've got to pay cash. That'll have a not as big an impact on the market as the other changes, but there will be some impact because it was quite a popular strategy, particularly for clients working with a financial advisor and accountants.